A single deal can define a career. It can change a life. For Henry Kravis, one deal didn't just define his career. It redefined the very fabric of American capitalism. We are talking about a man who didn't just play the game on Wall Street. He rewrote the rules. His story is not merely one of accumulating wealth, though he has done that on a scale few can comprehend. It is the story of an idea, a powerfully simple yet disruptive concept that turned corporate America on its head. This is the tale of the leveraged buyout, and Henry Kravis was its high priest, its most audacious practitioner. His influence is everywhere, in the companies we know, the products we buy, the very structure of the modern economy. To understand Kravis, you have to understand the timeline of his ambition. It starts not in a gleaming Manhattan skyscraper, but in the oil fields of Tulsa, Oklahoma. It winds through the hallowed halls of Columbia Business School and the rough-and-tumble trading floors of Bear Stearns in the 70s. It culminates in the creation of a firm, Kohlberg Kravis Roberts & Coers, or KKR, that would become a global behemoth, a machine for acquiring companies and reshaping them in its own image. This isn't just a history lesson. It's a playbook, a masterclass in seeing value where others see none, in using debt as a weapon, and in building an empire one audacious deal at a time. Kravis matters because he represents a fundamental shift in power. Before him, the managers who ran large public companies were kings in their castles, often insulated from the true desires of their shareholders. Kravis and his partners built a battering ram called the LBO to knock down the castle doors. They argued that companies could be run better, leaner, and more efficiently if ownership was concentrated in the hands of a few who had real skin in the game. They weren't just buying stocks, they were buying entire companies, grocery chains, hospitals, and betting they could make them more valuable. It was a high-stakes game that minted billionaires and sparked furious debate. The journey of Henry Kravis is a chronicle of big wins, monumental risks, and transformative impact. It's a story marked by milestones that read like a highlight reel of financial history, the early, smaller deals that proved the model, the epic, headline-grabbing battle for RJR Nabisco, the expansion into a global powerhouse managing hundreds of billions of dollars. His name became synonymous with the corporate raider, a term he disliked, but one that captured the disruptive force he unleashed. But behind the headlines and the controversy is a simple, repeatable strategy, a method that reveals the inner workings of modern finance and offers powerful lessons for anyone looking to build something of their own. Henry Kravis was not born into the Wall Street elite. He was a product of Tulsa, Oklahoma, a city built on oil money and pragmatic ambition. His father was a successful oil and gas engineer, a man who understood geology, risk, the hard numbers of a deal. This upbringing instilled in young Henry a certain grit, a focus on tangible results rather than abstract theories. He wasn't afraid of complex industries, or getting his hands dirty to understand how a business actually worked. This foundation, far from the financial centers of the East Coast, would prove to be one of his greatest assets. He learned early that value wasn't just found on a balance sheet, it was buried in the ground, in factories, and in the operations of a company. His formal education polished this raw talent. He attended Claremont McKenna College, before making the pivotal move to New York for his MBA at Columbia Business School. Columbia in the 1960s was a crucible of financial innovation. It was here that the intellectual seeds of what would become the LBO were being planted. Kravis absorbed it all. He wasn't just a student, he was a sponge. Corporate finance, valuation, deal structuring. More importantly, he was building a network. He met people who thought like he did. People who saw the financial world not as a static system, but as a dynamic arena ripe for new strategies. After graduating, Kravis didn't wander. He went straight to the heart of the action, Wall Street. His first jobs were in corporate finance departments of various banking firms, where he cut his teeth on the mechanics of mergers and acquisitions. But his destiny was set when he landed at Bear Stearns. There he worked under a mentor, Jerome Kohlberg. He called them bootstrap deals. Buy a family-owned business from a founder ready to retire, using the company's own assets as collateral, It was a small-scale version of the revolution to come. The break came in 1976. It was inevitable. The ambition of Kravis and Roberts had outgrown Bear Stearns. Their vision of using significant debt to take control of companies was too radical for the established order. So they did what all great entrepreneurs do. They left. With Jerome Kohlberg, they pooled a modest $120,000 in total capital. They hung a shingle. Kohlberg, Kravis, Roberts & Co. was born. Their office was small. Their team was tiny. But their idea was enormous. They weren't just starting a firm. They were starting an industry. Their strategy was deceptively simple. Identify established, often underperforming public companies with steady, predictable cash flows. Think of a business like a cash machine, cash coming out reliably. Then came the magic ingredient, leverage. KKR would borrow huge sums of money. They used that cash to buy all the stock, taking it private. The company's assets and cash flows became collateral for the mountain of debt. Once KKR owned the company, the real work began. This wasn't passive investing. Kravis and his team became intensely active owners. Replace management, scrutinize every line item, cut costs, sell non-essential assets. The business narrowed to one objective: generate cash to pay down debt. It was a brutal, Darwinian process. Final step, the exit. After 3, 5, or 7 years with debt lower and earnings higher, KKR would sell or take the company public. The spread, amplified by leverage, produced astronomical returns. Identify, buy, fix, sell. That cycle became the engine of a fortune, honed over decades. For its first decade, KKR operated effectively but largely outside the public glare, and they did big deals. Safeway, Beatrice Foods, making their investors and themselves very rich. But in 1988, they burst into the national consciousness with a bang. The target was RJR Nabisco, a sprawling conglomerate. Oreo, Ritz, Winston, Camel. It became the prize in the most ferocious corporate battle the world had seen. CEO F. Ross Johnson proposed a management buyout. Kravis saw an opening, a bloated company with iconic cash brands. KKR launched a competing hostile bid, and the war was on. Front-page drama for weeks: Kravis versus Johnson and Shearson, Lehman, Hutton. The price escalated in a frantic auction, billions tossed like poker chips. The saga became barbarians at the gate. In the end, KKR won with a bid of $25 billion, over $65 billion today, the largest LBO in history. It proved no company was too big to be a target and permanently changed the rules. The success of KKR was not built on luck, but on process. Management fees of 1.5% to 2% provided steady revenue, but the real prize was carried interest, their 20% cut of profits. Across multi-billion-dollar deals, that slice compounded, propelling Henry Kravis into the ranks of the world's billionaires. KKR grew from a 3-man startup into a public global institution, managing hundreds of billions across private equity, real estate, credit, and infrastructure. The companies it has owned span the economy. Toys R Us, Safeway, Duracell, First Data, Alliance Boots, and HCA Healthcare. Success brought controversy, debt loads, layoffs, short-termism, yet Kravis also channeled wealth into philanthropy. Arts, education, and medical research, including major gifts to Memorial Sloan Kettering, Columbia Business School, and Lincoln Center. Lesson 1. Focus relentlessly on cash flow. Durable cash-generating businesses weather storms, fund growth, and service debt. Cash is king. Lesson 2. Success is a team sport. Combine complementary strengths, finance minds, operational experts, loyal partners. Lesson 3. Take calculated risk, backed by exhaustive research, detailed models, and clear mitigation plans. Ultimately, find your playbook. Identify, buy with leverage, fix, sell, and apply it with discipline again and again. That is how you turn a single good idea into an empire.